August, here we are. Super hot out there too, isn't it? I mean, welcome to August in Florida. There's nothing like it. I think I heard on the radio the other day that the feels like temp was like 110. So that's almost like melting temperature. Hope you're staying inside, staying hydrated, staying cool, all of that good stuff. That heat stroke stuff is not particularly recommended from a medical perspective. So hope you're staying in good shape here in the heat of summer in Central Florida. Speaking of hot, we're going to talk to you this week about a hot trend in the financial biz of late, involving a lot of big financial firms are trying to get you to put your money into private equity, just another sort of subset of what is generally referred to as alternative type of investments. We're going to dive deep a little bit onto what this private equity stuff is all about, what's going on behind the scenes, like why this push, if you will. And at the end of the day, you might very well come to the conclusion that it is in fact something that you might want to be a little careful with and effectively steer clear of this new trend in the financial business. We're also going to talk about what, unfortunately, is a very real scenario for many folks these days, and many people find themselves impacted when a loved one starts to have cognition difficulties, and a number of folks that are impacted by Alzheimer's directly or dementia is expected to double over the course of the next decade. So that clearly is going to have an impact on the individual and also on the caregivers. So we're going to get into sort of four key areas that, you know, if you find yourself on this journey that you really want to be focusing on to help you get prepared for these very real issues of life. So welcome on into the program. This, of course, is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also a top 25 financial planning podcast. To get connected with us on any of those podcasts or social media platforms, just go to our website, nelsonfinancialplanning.com. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we've got a team of folks who also happen to be certified financial fiduciaries as well. And their purpose really is to help you make better decisions with your finances. That's about it. That's what we do each and every day at Nelson Financial Planning. So another week, another set of headlines. I guess if we reflect on the headlines, a couple of different themes dominated this past week. And they're themes that we've certainly seen a lot of over the course of the year so far. Federal Reserve met this past week, ultimately decided to continue to hold interest rates where they were, much to the chagrin of the White House, which obviously would like to see those rates cut. Also, interesting economic data came out on Friday involving the employment numbers, which actually saw a little bit of an uptick in unemployment. So again, all of this seems to be building that certainly by the next time they meet, which actually is in September, they don't meet in August. By September, we would certainly put the odds of an interest rate cut extremely high, particularly this past week when the decision was marked by the fact that there were two on the Federal Reserve board that actually dissented, said, wait a minute, we should be cutting rates, but the majority obviously won the deal, and so interest rates weren't cut. As we have said many times before, though, the downside on that is I guess you got to be careful what you wish for, especially if you have money in cash, particularly money markets, things like that, because any change in those rates, guess what that's going to do? That's going to reduce down the interest that you're making in those cash accounts. So the days of 12 months ago, 18 months ago, when those money market rates were up close to 5%, probably well in the rear view mirror. Certainly by the end of the year, you could see those rates under 3%. And then at that point, you're barely staying ahead of inflation. You're going to need to take a look at perhaps a different strategy for what to do with that money. Also, of course, this past week, corporate earnings continues to roll along. A host of companies reporting earnings. More importantly, and I think this was something that Zach and Christina pointed out on the show last week, with that August 1 deadline of Friday, we saw a tremendous increase in the conversations about tariffs. That impacted the markets on Friday, so you've had a lot of headlines. That topic, if you will, has sort of resurged or come back to the front burner, if you will. And I guess that timing makes sense, right? It was supposed to be like a 90-day kind of pause or a hold to let different countries negotiate, and certainly some did. Some tariff deals were certainly announced in the interim, but there's a number of them that are still outstanding. And so, voila, we have sort of that next sort of deadline of this past Friday, August 1. And so clearly a lot of conversation about tariffs back into the overall headlines and, of course, into the overall markets as well. So obviously an ongoing story there between the Federal Reserve and interest rates and what's going on with tariffs, and unemployment rates, things like that. So that's kind of the economic sort of where we are. I guess this week would be one where we would categorize it as, yep, a lot of headlines, a lot going on, nothing concrete in terms of action, but we suspect that we'll see that in the weeks ahead. Speaking of changes, another change happened, this one at the end of June, that really kind of starts to blur a little bit more the distinction between growth and value. Once again, we find that distinction sort of ebbing. And so we wanted to talk a little bit about that and kind of what the impact is going to be. First of all, the difference between value versus growth, those are two different styles of investing. Value, traditionally thought of as a little bit more of a dividend type of orientation. So a little bit more established companies that are taking their earnings and paying those out to their various shareholders. In contrast, when we think about growth and sort of that style of investing, you're looking at companies that are taking those exact same earnings and putting them back into accelerating the growth of that company. We're seeing a lot of that with a lot of the more technology companies, which would typically be where you would sort of see that more growth style, particularly when we kind of look at some of these numbers in terms of how much money those companies today, those more technology companies, are taking and plowing back into the AI sort of things in terms of the capital expenditures. But so that's sort of the difference. The growth side has always been viewed as having a little bit more volatility, and the value a little bit more dividend orientation, so a little less volatility. Ultimately, those dividends serve a major purpose in helping to generate out income, particularly if you are retired. So the issue, though, is that sometimes the distinction, we've certainly seen this before, sometimes the distinction can get kind of cloudy. And we're seeing that once again in two of the main indexes that sort of track value and growth. So we're talking about the Russell 1000 value, which is traditionally the value index, if you will, and the Russell 1000 growth, traditionally the growth index. Now, obviously, these indexes are very important in the financial world because portfolios will sort of look to benchmark against those indexes. And so what happens with any index, whether it's the Russell 1000 value, Russell 1000 growth, or the S&P 500, whatever the case may be, there's a regular change of the underlying holdings of the index based upon sort of how companies has performed. So if it's an underperforming company, they may drop you out of the index. If you're doing great, they may add you back into the index. And that is a pretty key concept when it comes to how these indexes work and sort of what's going on behind the scenes on exactly what's going on inside these indexes. So we're going to slide to a break. When we slide to the break, we're going to come back and we're going to kind of finish this conversation and just really highlighting what you need to know here And there's going to be a couple of key takeaways as well. If you've got an investment portfolio, you need to make sure that you're checking out a couple of different things as a result of these changes. So we're going to take a break. This is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents. To kind of cover the conversation that we were talking about before the break, talking about that distinction between growth versus value, right? Growth, more technology, you're taking your money and you're reinvesting it to accelerate future growth. Value, that investment style, usually thought of as being a little bit more dividend oriented because you're taking those earnings and you're paying them out to your shareholders. So as you might well expect, generally growth, a little bit more volatility, value a little less. Often you use that more value investing style, particularly when you're looking to generate out income in a client portfolio. So that's the distinction. What we're talking about, though, is that there can often be a lot of style drift, okay, particularly when the major indexes change to sort of morph and start to look a little bit like they perhaps are skewing into other areas that aren't traditionally thought of as more growth or more value. To really kind of get to this specifically, we're talking about the Russell 1000 Growth Index and the Russell 1000 Value Index, the two sort of premier indexes for measuring those types of investment styles. Well, at the end of June, because of regular sort of changes that happen in the indexes, and this happens to every index, like some companies get dropped, some companies get added in, and ultimately there was a lot of changes in the Russell 1000 Value Index that you could really argue that are making it a bit more of a growth orientation. Specifically, it wound up with a much higher allocation to both information technology and communication services, to kind of more growthy areas, and less exposure to industrials, financials, okay, which, as you might well expect, those are generally kind of more value or dividend areas. Specifically, there were three companies, three very high-profile companies that were added into the value index that you would say, that doesn't sound like your traditional type of value or dividend-paying companies. Three companies would be Amazon, Alphabet, previously known as Google, and Meta, previously known as Facebook. So not exactly classic value names getting added. And the issue is that they were getting added not just a little bit. The addition of those three names will now account for almost 6% of the entire benchmark. And remember, this benchmark is supposed to be a benchmark of, as the name suggests, Russell 1000 Value, 1,000 different companies. So literally the core components of the index have changed, and these three companies get added in, and now they account for 6% of an index that is 1,000 companies. So here's the point. Here's how it impacts your investments. First of all, we've seen this before. Changes in indexes have a tendency to be very retro looking, right? They drop out companies that haven't done as well of late, and they add in companies that have done great of late. So that means that you might very well find yourself kind of coming late to the party, with increases the possibility of sort of getting whipsawed. And certainly history has plenty of examples of when it comes to that in terms of how these index components change. Second, and here's really the point, and I think it's sort of the recurring theme that you hear a lot on this program if you're a regular listener, and that is this notion of knowing what you own. You've got to really dig deeper, because it's not enough to just say, well, I'm looking at a metric and I see growth style, investment style, value investment style, and those are the percentages. But you've really got to take a little bit deeper look, particularly at how big some of these growth companies are and how much they will drive the performance of the index. So you really got to kind of take a little bit deeper dive and look at the actual top holdings that you own in your portfolio. So if you're a predominantly growth investor and you've got some of this value stuff in there to help balance things out, you may find that as a result of these changes in the index, well, wait a minute, it doesn't look like my value side is doing what I wanted it to do in terms of my portfolio, because if all I'm doing on the value side is loading up with Microsoft and I'm sorry, not in Microsoft, Amazon, Google, and Facebook, well, then how is that really any different than what I was doing on the growth side? So bottom line, make sure you are digging a little bit deeper, particularly in today's world, to actually look at the individual company holdings inside your particular portfolio. Those are crucially important types of things. Similarly, crucially important is what to do in a situation where you or a loved one or someone you're giving care for has had a diagnosis, whether it's Alzheimer's, dementia. Obviously, the number of people that are impacted continues to go up each and every year. And so we wanted to sort of segue and give you 4 areas to focus on to make sure that if you find yourself in that situation, that these are the things that you need to be kind of working through in order to make sure that you're putting yourself in the best possible position to kind of deal with all of this, because you've got a bit of a journey in front of you. And as you know, if you're a regular listener to the program, I find myself on that journey on a personal basis. I am the primary caregiver for my mom, who was diagnosed with dementia a few years back. And it's a journey. If you've ever been on that path, you know that there's a lot going on with that. And so the purpose of this portion of the program is to give you some things to be thinking about, to make sure that they are in good order, to make life a little bit easier should you find yourself in that situation. So the 4 areas. First of all, starts with the legal documents, right? I mean, this one is crucial because if the individual is in the process of losing capacity or has lost capacity, then they can't actually sign any of those documents that you might need to have in place in order for you to be able to make decisions on their behalf. And if those documents aren't in place, then guess what? You find yourself going through a court-appointed guardianship type of process, which is, as you might well imagine, very time-consuming, expensive, and, kind of invasive when you stop and think about it, because you wind up having to go through the court and whenever you need to make big decisions. So make sure there's a power of attorney in place. That's the one that gives you the ability to help manage their financial affairs. Now, typically with a power of attorney, there's usually a couple of choices. You can have a springing one or you can have a durable one. The reality is that you probably want a durable one to make life easier. There's some pros and cons on that. But with a springing one, you got to prove incapacity. With a durable one, voila, you have capacity no matter what. Be careful, though, because that means you have capacity no matter what, and you want to make sure you've chosen the right person on that. Similar documents that are crucially important, again, while somebody's alive: healthcare surrogate, living will. Obviously, you want to make sure that the rest of the legal documents are in place as well. Things like a will, potentially a trust. We always say make sure that when you look at the accounts, wherever they might be, bank accounts, investment accounts, whatever the case may be, make sure you've named beneficiaries on them. Way too often we see people overlook that, and ultimately that means that those assets are going to have to go through probate when that person passes. You can avoid all of that by naming people properly as beneficiaries on each of those accounts. So legal documents, that's the first area. You want to really make sure you got a pretty good handle on all of that. We got 3 other areas, though, that we want to kind of dig into, and we will do that after this break. So stay tuned with us here on Dollars and Cents. My name, of course, is Joel Garris with Nelson Financial Planning, and we're going to continue this conversation of some of the areas that you really need to focus on if you find yourself in that position of having to provide care for a loved one who is having a cognitive decline. That, and we will continue after these messages. On the program, we're talking a little bit about those 4 areas that you need to be focusing on if you find yourself providing care for a loved one whose cognitive abilities are in decline. We talked about really getting on top of the legal documents. Obviously, that's kind of the first area you want to focus on, because if they don't have the right legal documents in place, you're going to have a very hard time getting those legal documents in order, particularly once they no longer have the cognitive ability to be able to make decisions. So make sure you really take the time to find those documents, know where they are. The most important of all of them is a power of attorney, because that's going to give you the ability to act on that person's behalf. Throw in a healthcare surrogate, which allows you to kind of work or operate in the healthcare arena, a living will, which gives you guidance as to what happens when things get terminal, and you've got sort of those the three legal documents that you need to make sure you have in place. The other stuff, will, trust, all of those kinds of things typically take greater impact, particularly the will, once someone passes. The simplest way to avoid any issues at all is to make sure that all of the investment accounts, the insurance policies, the annuities, the titling, whatever it is, make sure you've named beneficiaries specifically on those types of assets, and then you'll be able to have all of those passed without having to go through probate. So that's number one. Number two, of course, then is the bigger financial conversation, right? What does it look like from a money management perspective? What does it look like from a cost of care perspective? And does the approach and the investment allocation need to change? The reality is that probably, yeah. Obviously, that depends on the individual person. But when we think about an investment allocation, if you're needing to draw a much higher amount of money off of an investment portfolio, then you probably want to make that a little bit more on the conservative side. Similarly, the approach actually changes as well, because, and here's where you got to kind of start to think about, how do the taxes integrate with the investment strategy that's being used for the particular situation that we're dealing with. So if you're dealing with like a nursing home or something like that, well, that expense, which is going to be really high, but that expense is a medical expense. And so then you wind up with a tax deduction that you could use. So in that case, what we typically advise folks to do is maybe take a little bit more out of the retirement account side. And then that way, yes, you do have higher taxable income as a result of that. But remember, you've got then a higher amount of a deduction that you could use to offset that income. So beyond just the allocation changing, when you find yourself kind of in this caregiving role for someone with cognitive issues, you may also want to be rethinking the approach as well in terms of where the money is coming from in order to cover those expenses. Because if you're going to have a deduction for medical expenses, well, then you might as well have income that can be used to be offset by that medical expense deduction. So it does, in fact, require a deeper dive into the overall finances. So that's sort of the second category. The third category, which can often be somewhat tricky, is what do you do with the house, right? Let's say they're still living in the house, and everybody loves the idea of aging in place, right? According to a recent survey, something like 77% of Americans age 50 and older said they were not leaving their house no matter what. The reality, though, it sometimes looks a little different. The house has ongoing expenses of maintaining the house, and if you're trying to cover a much higher medical expense, then maybe there's a trade-off there that you need to start to make. If you go into a facility, sometimes there's entrance facilities, the house, because typically when you sell a primary residence, there's no tax implications, so all of that money comes tax-free, which means then that you could use those funds to help pay for an entry fee or to help pay for some of the additional medical expenses. So the house becomes a big topic, but also a tricky topic because of that emotional connection that we can often find when it comes to the house. So going to have to kind of navigate through that one. And then lastly, and this is a general topic, and we're going to kind of combine this into the technology space, if you will. Can't forget about how much life and society is changing. The reality is that we're going to kind of intersperse security in there as well. So certainly important to get passwords, logins, things like that. But in today's world, make sure you're also kind of paying attention to scams and frauds that can be technology based, whether that's a text to your phone, a call to your phone, something you click on, whatever the case may be. Obviously, if there's a cognitive decline, then that makes that individual a little bit more susceptible to becoming a victim in today's world. Although that doesn't necessarily come hand in hand, we've certainly seen plenty of young adults that have found themselves getting scammed through a variety of different types of approaches that are out there. Bottom line on this, you just got to be very careful and make sure you're putting up sufficient guardrails to make sure that your loved one with declining cognitive abilities isn't getting taken advantage of with scams or frauds or whatever the case may be. There's just way too many examples of that. So when we think about technology, we think about technology and, more importantly, security. So make sure you've got the right passwords, logins, things like that. But also make sure that you're creating guardrails to prevent kind of scams, frauds, things like that can happen on a regular basis. So those are kind of the big four, if you will, in terms of areas to really be kind of thinking about when we're thinking about providing care for a loved one with diminishing cognitive abilities. Make sure the legal documents are all tip-top, all in good shape. You know where they are. They're signed. They're executed. Everything's good. Get a better understanding of the finances. Certainly the allocation and the approach might very well be changing on you. And you certainly want to be getting a handle on that. Figure out what to do with the home. That's always a tricky one. But at the end of the day, you might need those dollars that would go into normal home maintenance to go towards helping to pay for the increase in medical cost, combined with the fact that you get a big old pile of money when you sell the house, and that money comes to you without any taxes. So good little resource to be able to pay for some of these medical expenses. And then lastly, that notion of kind of technology and kind of security that kind of comes hand in hand. Far too often, way too many scams and frauds out there that at the end of the day, you certainly want to be very, very careful with. So some things to certainly be thinking about. In terms of other things to be thinking about, there's, I guess, a growing trend. According to a recent Wall Street Journal article, they called it the private markets craze. And this is just kind of another of the trends in the industry that, that we talk a lot about on the program and certainly have over the 25 years we've been doing the show. And, all too often, these new products, these new approaches, there's much more going on than kind of meets the eye. And unfortunately, they typically wind up costing investors more than they realize. All too often, the financial industry likes to roll out new products or new options. And at the end of the day, guys, they're not really doing it for your benefit. They're kind of doing it for theirs to maintain profitability. The question that they typically ask is, can this product sell, and how do we get more of this product sold? And I think that's part of the explanation behind why this sort of push or this latest trend of trying to push people into private equity is happening out there. So we're going to break down what exactly it is, what exactly we're talking about when we get back from the break here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're talking about the latest trend out of the financial services industry that you really kind of need to keep your radar up for as an investor and be very careful about, because it's really going to be pushed onto the investing public, and you really need to understand what exactly it is that they're trying to do. And what we're talking about is sort of this expanding opportunity to invest in private markets, or as a recent Wall Street Journal article referred to it as the private markets craze. So what's going on? And so we'll start with sort of what it is, right? And investing in private markets is very unique and not really something that's generally available to the regular investor, right? I mean, you can invest easily in public companies like Amazon, Microsoft, that are available to anybody on the stock exchange. That, by virtue of them being publicly available or available to everybody, that makes them public companies. But the flip side is that there's also a lot of private companies out there. Private companies like Nelson Financial Planning, for example. Like, you can't buy stock in Nelson Financial Planning because we're not a public company. We are a private company. And the reality is that the private markets sort of focus on those companies and loans that are affiliated with those types of companies, and obviously not readily available because they're still private, but they are a area where a lot of folks in the industry are saying, well, we want to be able to give John Smith, who's an average guy on the street, we want to democratize investing and give him the opportunity to get into this area of being able to invest in private companies, or being able to give a loan to a private company. So this notion of private equity, private credit, the reality is it's long been kind of restricted to pensions and endowments and other institutional types of investments. One is more sophisticated investors than just the average person. But this push is, say, oh, we're going to democratize investing so that everybody has the same opportunities. And sort of the other part of the argument that you hear as to why this push is being made, beyond this democratizing investing argument, is that there are less opportunities in the public market these days. And you wouldn't think of it that way, but there really are. If you look at the number of publicly traded companies, the number of publicly traded companies has declined quite a bit over the course of the past 20, 30 odd years. In 1996, there were 7,300 publicly traded companies here in the U.S. Today, it's about 4,300. So quite a bit less, I guess, environment in which to choose from in terms of the number of publicly traded companies. And so that's sort of the reason why you're kind of hearing some of these conversations. And even in Washington, there is sort of an encouraging theme to look at the ability to invest in these private companies or private credit or private equity. And in fact, rumor has it that the Labor Department and the SEC are actually going to provide, or going to be asked to provide, to create some guidance for how you can get this stuff included in 401k plans. And so all that, sounds lovely, but there's always more to the story. So, and it starts with just, I guess, kind of a common sense one, which is if the behemoths of the financial industry are jumping into this, you should probably start to ask why. Been in this business long enough to know that if the industry is starting to push into a new area, chances are pretty high that they figured out it's an area that's got a little bit more profitability, and not actually doing it to sort of help individual investors. Chances are that there's money to be made, and they want that share of it. And part of the issue is that what's happened just in the industry as a whole is that the costs of the more traditional approaches, right? The traditional ways to invest money, whether it's mutual fund, as a result of index funds, I mean, that cost has been driven down to nearly zero. All right. And so if you're in the product side of it, then you start to run out of ways to improve your revenue and become more profitable. And so the chance to sell these types of investments, these alternative investments, or these private equity, these private market types of investments, they come with much, much higher fees. And because of that, then if you've got an opportunity to sell those funds with much, much higher fees, well, then that helps your profitability. Why do they have much higher fees? Well, simply put, the lack of transparency that exists when you buy something in the private market. So that should be somewhat self-evident in terms of kind of where that higher cost would be. And so it's being viewed from the perspective of the industry, much like anything in this sort of category of alternative investments, to get the end customer, which is you, investing public, to effectively pay more than what you do when you own a mutual fund or an index fund, which is why private equities and private markets and alternative investments have really kind of been ramping up of late. I think a clear example is you look at a company like Vanguard that is jumping into this area of private markets, alternative investments. And so on one hand, you've got them advertising, they're advertising this right now, is we just engaged in the single biggest fee reduction for investors ever, right? That's the ad. Maybe you've seen it. But rest assured, Vanguard, I'm pretty sure, still wants to remain a profitable company. So how are they going to continue to maintain that same level of profitability? Well, lo and behold, a lot of people have money with Vanguard. And so by shifting into these different areas of investment products that have higher fees, then you can maintain that profitability. And ultimately, who pays those higher fees? You got it. You do. And so beyond that concept of kind of higher fees and what the financial services industry is doing and using these as a way to boost profitability, there's a couple of other things that you really need to know as an investor before you kind of jump into this. First of all, if it's a private-based investment, it's going to tie up your money. Like, again, if you buy shares in a private company, then there's no public market. There's no instant liquidity for the shares in which you bought. So you can find your money tied up for 5, 10 years as you wait to be able to get that money back out. So not a lot of liquidity or ease of accessing your money when you're talking about these kind of private investments. And then, of course, because it's private, there's no track record. So you have no idea how things have done in the past or what's the real prospects looks like for the future. Key difference between a private company and a public company is, every 3 months, a public company has to report its financial results and sign off on that they're, kind of true and accurate. So that's a pretty big difference. So bottom line on this, and I think this is kind of the theme of the program, if we think back to kind of some of the changes in the index that are happening to the Russell 1000 value, Russell 1000 growth index, particularly the Russell 1000 value, is you've really got to really have a good understanding of what it is that you own. Okay, that's crucially important in today's world. Know what you own. We say that all the time on the program. And then the sort of the second part of that is caveat emptor, right? Buyer beware. Make sure that when you're hearing about new products and when you're hearing about new pushers in the industry, particularly like this one here on the private equity side of things, that it's not an attempt to force you into a much higher cost type of investment where you have no idea what the performance has been or what it might be, and your money is just tied up for an extended period of time. So just be careful with all of that. I think there's currently $12.2 trillion in target date funds in the 401k space. Something like 60 cents of every dollar that gets saved these days in employer-sponsored plans is going into those target date funds. And so that's one of the areas specifically where they're saying, well, a target date fund, what if we had a little percentage that goes into this alternative investment, private equity stuff? Be careful, folks. At the end of the day, it is not nearly as good as it is billed, particularly for the individual investor, right? Common themes: buyer beware and know what you own. Those are the kinds of things that we work tirelessly with our clients on every day to make sure they understand and are properly educated about their investments. With that, we're going to get on out of here and wrap it up. This has been Joel Garris of Nelson Financial Planning on Dollars and Cents.